Hey everyone, welcome to the KE Report Daily Editorial on Monday, November 17th, chatting with Craig Hemke. Craig is the founder and editor of TF Metals Report. Craig, we are chatting off mic, looking at these markets, and quite frankly, it's just kind of boring out there. Metals and the broad averages. We seem to be getting a bit of a fade in share prices. We're not talking about all-time highs like we were week after week. We're talking about a whole lot of range-bound trading, and it feels like any commentator you listen to, or at least a lot of commentators out there, no matter what sector they're talking about, everyone's saying it's due for a bit of a correction. Stocks around every sector have run so much this year that it almost feels like we're in early Christmas trading, where people are moving away from their desk and slowly building up cash, but really just not doing a whole lot. Wondering what you're seeing out there, especially on the metals front.
Yeah, hi guys. It is, let's call it the dog days of December, or at least November, as it's kind of like the dog days of summer, where European traders all take the month of August off, and a lot of Americans are on vacation prior to Labor Day, and it's just a quiet, listless trade usually. And that's what the metals were doing, actually, back the dog days of summer this year. Remember, gold peaked out on what, April 22nd? And then didn't really break out till about the 1st of September. So we kind of had a little dog days of consolidation then, consolidating gains from the first half of the year. And we're kind of in the same dog days of consolidation now, it seems. Across all markets, like you said, specifically the metals, it's not, again, unusual in any at all to have rallies and then, within a bull market that then pause and consolidate and work off some of the bullish extremes or extremes in sentiment or whatever. But it does accomplish a couple of things. I think it's particularly in the shares that you mentioned, Corey. We are now past the halfway point of November, and we're pretty much through all of the third quarter earnings. And I don't want to speak out of turn, but I think for the ones I saw for the producers of gold, they were all selling their gold in the third quarter at about 35 to 3,600 maybe, if there was an average price for most of them. Well, I mean, it's now November the 17th, and I don't know if gold has barely closed any days below 4,000 this quarter, a handful. I mean, even right now as we speak, it's what, 40, 50, or 60 or something. And silver, I don't know what the silver miners were selling their silver for in the third quarter, but it certainly wasn't the average of $50 or so that we put on for this first 6.5 weeks of the fourth quarter. So the longer we go sideways, just go sideways. I mean, these miners are locking in, another 10, at least 10% higher prices in the fourth quarter versus the third. And I got to figure that's going to be eventually be reflected in a rally. Will it start in December? Typically it's after, you get a rally after tax loss season. I don't know, not a lot of losses this year, but usually the back half of December, seasonally pretty good. That might coincide with the December Fed meeting. We're now down to just a 40% chance that there's going to be a rate cut in December. Let's just see what happens once we get caught up with some of the U.S. government data. And if that starts to slide back toward 60% or something like that, and then heaven forbid, what's his bug Powell even does end up cutting or is very dovish for January or something. I mean, all of that could surge in an impetus to kind of get us going, in a few weeks from now to break us out of this dog days of December.
Well, Craig, the dog days of November, dog days of December, as you say, it's kind of like that summer trading pattern. But the point you made is so germane. I mean, I was actually just writing about this weekend that when you think about the average price in Q4, as you outlined, over 4,000 for gold, when the average price in Q3 was around 35.60, I think. The average price in silver, as far as I can figure out, Craig, is around $39 in Q3. Well, if we're at 48 to 54, so maybe close to $50 average so far, why aren't people front running that more? Why are these stocks selling off the last couple of weeks in that kind of environment where they're at record margins? Or is it something where you think the market is leaning towards the metals prices to keep going lower and lower? But even if they did, it'd still be record prices. So why aren't people buying this now instead of waiting till later in the quarter to do it?
Well, it's a good question. Conviction, and people think, oh, gold can't stay up here that long. And so they wait and think that some pullback is coming. You certainly got a lot of chart readers on the internet and at investment banking firms that think maybe the price is going to come back even further. And so you wait and hold off. to see if prices do hang in there maybe till the last moment or until the train starts to leave the station again, and then everybody piles in. I referenced that period in the spring where gold went sideways from the end of April to the end of August. Was it 4 months? That was a period that had the second quarter earnings in it, which would have been in kind of that actually was in July, if I remember right, when we started getting the second quarter earnings. And the metals pulled back, or I mean, the shares pulled back, and the GDX as a proxy pulled back. And I was like, what's going on here? And then it was about the 1st of August, while gold and silver were still stuck for another month. But it was about the 1st of August that the shares started to rally. GDX took off. So what were we at that point? About 1 month into Q3, and here we are halfway through Q4. So I'm not sure how much longer it will take before you get the herd mentality kicks in again, and you don't want to be left behind and fear of missing out and all that kind of stuff ahead of fourth quarter earnings. But again, every day that we go sideways and more gold and silver are sold at $4,000 and at, $50, these companies are locking in. I mean, you think the third quarter looked great. Oh my gosh. 15% higher in gold and 20% higher in silver. I mean, anyway, we'll see. A lot of this has to do with overall stock market sentiment and risk appetite and the rest. But I just suspect that'll improve seasonally, as it always does, once we get in December. And maybe that's when things will pick up again.
Craig, I feel like this whole year we've been talking about earnings reports and looking forward to the earnings reports. And each quarter, these stocks have delivered. We're seeing record revenues, record cash flows. Some in the last quarter in Q3 even reported lower costs. We're not seeing skyrocketing production, but we also know that because these companies are telling us that it's hard to bring mines online and ramp up production. That takes a while. But after all of these earnings reports have come in, did you notice any sort of market reactions on the upside in any of these stocks where people truly did start to rush in and take notice of, again, what we've been seeing all year? Record earnings, record revenues.
Yeah, again, you get these, it's a 2-step forward, 1-step back routine that you get in bull markets and just about everything. I'll pick out one that's a personal favorite that has made me a lot of money. And again, you can cherry pick anyone that you want, but I'll use this one to answer your question. I started buying Lundin Gold last year sometime, year and a half ago. It was $18, $20. I think it entered the year at, 23 or 26 or something like that. It went up to 80 last month. And then when the markets got waxed, about 3 weeks ago today, 4 weeks ago today, and gold fell so sharply, it went from 80 to 60 intraday and then stabilized and went back up. Well, anyway, after another just fantastic earnings report and low cost and everything else, it made another new all-time high just last week, 82 or something on Friday. So there are individual stocks that have traded well off of their earnings report. And then there are others that seem like, traders just kind of head for the hills. They figure like, well, okay, that's the best news this is going to have for another 90 days. I'll, step to the sidelines. So it's, like I said, you can kind of pick one or two and, and highlight one or downplay another. In general, we've had a great year. GDX is up 100 some odd percent year to date, and there's some shares that are up 200 and 300%. So even though I think there's a lot further to go, and I think the fourth quarter earnings are going to be great, you get that kind of a move in anything, you're likely to get, kind of pay for it with some sideways to downtime, as people get impatient and take profits and the rest. And that's kind of what we see in the shares in general through the earnings season.
Well, Craig, just to that same point, if you think about any sector, when it has a outsized year, whatever that flavor of the year is, it usually doesn't have that same flavor the next year and the year following it. It's usually not a one-hit wonder, but whatever sector it is, if it was uranium in 2000, it was lithium, and I mean in 2020, it was lithium in 2021, and it was copper in 2022, and it was oil in 2022, and then it was palladium in 2023, and it's been gold and silver in 2024 and 2025. Does that mean we look forward to 2026 with maybe not the same kind of robust year we had this year?
Well, see, now that's all part of the question I've got to ask myself as I get ready to write this next year's macrocast. My forecast for this year, I thought gold would kind of revert to the mean. If you look at the chart, Ronnie Sturflo always puts out a chart in his In Gold Trust report of gold's gains every year since the year 2000 in every single major currency. And looking at, in dollar terms, in the last 25 years, I don't think there's been 3, maybe it's 4 years of 25% gains. One of them was last year. And in all of those instances, following a 25% gain, about the best you could do is maybe 10 the next year. And a lot of them were flat. Maybe one was down. And so I thought coming into this year, I was like, well, we just did 25. Maybe we'll do 10 this year. Nice call, Craig. So, okay, wait a second. Now, hold on. When has gold ever had a 60% year? I don't know if ever. And so that one, it's like, okay, that's interesting. Does that mean now we're going to have a 30% down year next year? But maybe there's something really unusual taking place here, underlying everything we've seen, because this is so unusual and unprecedented to have gold stack this type of year on a 25% year last year. And so we'll just have to see where this plays out and how this impacts things in 2026. But I lean toward going from here. It almost feels like really, I hate to use the word smart money because it makes it sound like the three of us are like some kind of disconnected dumb money, and I don't think that's fair. But it's almost like really like big institutions and individuals and central banks and the like are front running something. You know what I mean? Yeah, because again, this is such an outlier of a year that what are they getting ahead of by continuing to accumulate after we had a 25% last year? These are all questions that I got to be asking myself too, Shed.
Greg, if we carry that over to other traders, then we're always looking for new money to come into the sector. If gold doesn't perform as well as it did this year, which this year was a banner year, I think the other time it went up somewhere around this much was in the late 70s, but I'm not positive on that. Does that bring in more investors, or does it shy investors away if we've, in a way, maybe front loaded a lot of the gains and next year, even if gold goes up, but say it goes up a more reasonable 10 or 15%, does that excite other money to come in?
Yeah, that kind of gets back to some of the discussions we had earlier this year about whether the market in general needs to, or if it were to shift its focus from growth into more value, like the old time arguments, growth versus value, income versus growth. And, everybody's been so focused on just growth and absolute growth. It used to be great. You could double your money in 5 years, 14% a year. That was unbelievable. Now if you don't double your money in 5 months or 5 weeks, what are you doing? And so I wonder if the market sentiment, I guess I'm getting to answer your question eventually, Corey. It is kind of getting back to this discussion we've had about whether market sentiment needs to shift toward, what if the gold price goes sideways next year? And all things being equal, or let's just put it this way, the gold price goes up at the same rate as input costs go up. Cost of labor, for a mining company, energy costs, everything else. And so their net margin stays the same. And what does that do to a stock like Lundin that I mentioned? I mean, they just keep cranking out quarter after quarter of all this cash and all this cash. Do people, because they want more growth, does that drive investors away from the sector? Oh, this just isn't doing it. I got to get back into NVIDIA. That's, again, a hard thing to anticipate, but that's a question that I think we're not going to have to wait long to get an answer to, because it'll be interesting to see how much has been front run this year in terms of the gold and the silver price and the shares, and how much, perhaps if they're front running, there's a lot more to come next year. But for now, yeah, if they just go sideways and the gold price goes up and the net margins remain the same, I don't know what the answer is. I don't know how the overall market will react because of that inclination to be so heavily on growth.
Yeah, Craig, I'd submit that even if the margins go down, even if they contract, they're at such huge levels right now, record levels, that they'll still be printing a crap ton of money, real money, gold and silver, as they pull it out of the ground. So even if we see silver pull back to the 40s, they'd still be having great margin. If we see gold pull back into the mid 3000s, they'd still have huge margins. My question is on the developers. They are getting valued in some of these takeover deals at $50, $60 an ounce in the ground. Some of the better ones, $100 an ounce in the ground. Have you ever seen such a disparity between what the development projects that are the quote unquote next mines are getting taken over for, what people are paying for them, and versus what the producers are actually making on an ounce of gold or silver? I've never seen the disparity this large.
Well, I almost would have to ask you, Shad, to answer that question yourself because it's just that's not. I don't have enough experience. I haven't followed that kind of metric closely enough to be able to give you a good answer. But I will dovetail that into something that was on my mind as I was answering Corey's question. If we get to a point where gold is, say next year, like I said, only goes up 10% on the year. We finish this year at 4,000. We finish next year at 4,400. And the margins, like I said, remain the same. We might get into more of this kind of stock picking market, and trying to find those companies that might be, that, well, wait a second, they're paying up to $100 an ounce in the ground, and this one is valued like it's only sitting at 10, but I could certainly see a case where it should be worth 50, that sort of thing. Because even like the merger we saw, 2 weeks ago of Core and what is it, New Gold, right? These companies are, I mean, every quarter that goes by, they're paying off debt, in some cases eliminating it entirely, increasing their dividend because they've got all this cash. At some point, I mean, they're going to be more and more spending. They're just going, I mean, what the hell else are they going to do with it? The cash that they're banking, except outside of it, securing future production to replace, the stuff they're going through now. So we might just transition more into, okay, I own some good companies, paying a good dividend, that kind of stuff. But we got to be more selective in our stock picking because, we might be able to pick off some nice home run balls.
Well, I think that's what the sector's waiting for. They need these majors to start spending money on these development projects to bring up the general valuations of them. And these companies don't even pay good dividends when you consider what you can get dividend wise elsewhere. So, yeah, we really need the majors to start spending, and that really lifts everything. It frees up a whole lot of capital in the sector. Craig, regarding trading right now, look, we always this time of the year usually talking about tax loss selling. There are not many losses, if any, in the sector this year, except for people that maybe bought in the last month or so when we've had a general pullback in the stocks. The one headwind I see is a lot of shares coming free trading because of all the financings that were done really over summer and up to this day. There's still a lot of financings being announced. So those shares we need to churn through. But again, everyone's sitting, or most people are sitting on pretty decent gains and probably have already taken some gains throughout this year. So how does that change your analysis for the end of the year type trading?
Yeah, that's always been a part of the seasonality, it seems. Get to under pressure until the middle of December-ish. I don't know, before Christmas at least, get it all done by the 20th. And then, that usually that week between Christmas and New Year's, maybe 4, 5 market days, it's like, wow, did you see the move in some of these shares that get bought back, and into January. And again, anytime you see a seasonality chart of the mining sector, it's right there for everybody to see how consistent that is. This year, you don't have the tax loss component hanging over it, but that may be about the time. To Shad's question earlier, that might be about the time. We'll be deep enough into the quarter. I mean, only a couple weeks left to go that investors realize, wait a second, and they start heading back in a different form of seasonality, but maybe a seasonality nonetheless. And again, a key item hanging out there is this December FOMC meeting, which concludes 3 weeks from Wednesday. Between now and then, there's going to be this massive catch up of not so much we're going to get the September jobs data on Thursday of this week. Okay, so the report in the US for the jobs market, we should have gotten on October the 3rd. We're going to get this week. They said last week, we're not even going to get an October report because it would just be impossible. But we will get all the December data. So between now and 3 weeks from now, when the Fed meets again, you're going to get all kinds of catch-up data and fresh data. And by the time we get to December or whatever the hell it is, that's going to be, I mean, the picture may look entirely different than it does now. Yeah, December 10th is that next meeting. So that might be, again, without the tax law selling component of it, there still might be a seasonality here of people just waiting to see what Powell does in December and how the summer of economic projections looks and all that kind of stuff. And then you get that kind of Santa Claus stuff, and that may be what kind of kicks off the seasonality this year rather than just simply a reaction to the tax law selling.
All right. Well, Craig, we will wrap it up here. We'll be chatting with you in another couple weeks. But yeah, as of right now, it just feels like we're a little bit early into end of the year trading, but that is after really a banner year. So a lot of eyes, I think, on next year and just what's possible for the metal space and what the markets are going to do. Again, seemingly never-ending people saying that these markets are due for a pullback, which we all agree with, but we've been hearing it for a while. Again, Craig Hemke, founder and editor of TF Metals Report. Click that link in the show notes to follow along with what Craig's writing. Craig, thanks for your time. Have a great rest of your week.
Thanks, guys.